Welcome back to The Exchange. The financials are one of the worst performing sectors today after yesterday's strong performance. These names are at a 52-week low. At least they were on Friday. They're barely above those levels right now. JP Morgan, one of the only components in the green as its investor day or days continue. And according to my next guest, JPM is in a better position than peers thanks to a few factors, including Jamie Dimon's leadership. Joining me now is Ebrahim Poonawala. He's financials analyst at Bank of America. Aren't you supposed to say B of A is the best bank, Ebrahim?
Well, Kelly, I'm not allowed to comment on that, but you can make your own choice.
Yeah, you say where I work speaks louder than who I cover. No, in all seriousness, we heard this yesterday as well from David Bahnsen. He said JP Morgan was the only financial name he'd own right now because he thought their franchise was so powerful in every aspect of the business that they have. What's your case for owning JP Morgan here?
So that's right. I think what the Investor Day did was it was a reminder in terms of the scale that the JP Morgan franchise has. When you look at $4 trillion in assets, 66 million U.S. households, banking 90% plus of Fortune 500 companies, I think when you marry that scale in terms of the clients and the innovation in terms of the investments that the franchise is undertaking, I think that makes JP Morgan from a medium to long term a very hard competitor to beat, and it makes the bank extremely well positioned when you think about what's happening with the banking industry in terms of digital innovation and changing customer preferences.
Yeah, I wonder about what they said about tangible common equity yesterday as well. I mean, if they can hit, was it 17% that they said that people seem to like? How significant is that achievement to the stock, and how likely is it to happen based on recession and inflation concerns?
So that's correct. I think if you take a step back, Kelly, if you go back to January when they first laid out their investment spend, the stock sold off. I think shareholders and investors were frustrated based on our conversations just around the fact that management probably didn't connect the dots enough in terms of how these investment spend would impact future growth and impact profitability. I think what management did yesterday was reassure shareholders that despite these investments, they've not taken their eye off in terms of disciplined expense management and capital allocation. So when you think about the return on tangible equity, as you pointed out, they left the door open that they might hit that number of 17%, possibly in 2022, likely 23. I think that was better than what the street expected coming into yesterday. And again, I think the signaling value is important in terms of it shows that despite all these investments, be it the UK digital bank, things that they are doing with blockchain and stable and crypto, they are able to deliver best-in-class returns. So I think that was a positive. But the other part of your question, if we do hit a rough patch, and I think you heard Jamie Dimon talk about the economy is strong today, but there are storm clouds on the horizon. So I think if we do, in fact, enter a recession over the next year or two, maybe that return target gets pushed out a bit.
What would the simple explanation be? I mean, if you told most people, hey, the 10-year is going to double, what's going to happen to bank stocks? They would go, I don't care, but I want to buy them. And instead, the opposite has happened. JP Morgan's down 20% this year. The financial spider ETF, but down about 13%. Why?
Yeah, I can't walk around the hallways here without someone stopping me and asking me that question. So I think the very simple answer to that is, if you take a step back, I think the big picture view is the Fed needs to hike interest rates in order to bring down inflation. As a result of that, I think the takeaway is the Fed will do some real damage to the economy. You've been talking about that throughout your show. What we don't know today, when the Fed hikes 50 basis points in June, maybe another 50 basis points in July, where will the economy be in terms of the demand destruction that will inflict, and where will the job market be? So I think as a result, you've seen bank stocks trade poorly starting mid-February when you had inflation expectations get worsen, the war in Ukraine that began, that also sort of impacted outlook for inflation, and then you had the China supply chain disruptions in March and April due to the lockdown. So when you add all of this, you're in wait and watch. And what we've been telling clients is we're not going to get a good understanding of where the economy is until maybe we get to later in the fall, post-Labor Day, to assess whether, one, what's the damage that's been done to the economy, and second, whether we do get a soft landing and the worst of Fed tightening might be behind us this summer.
Yeah, and again, not that the PE is the most important thing, but 11 times is still what JP Morgan's currently trading at. Ebrahim, thank you so much for joining us today. Appreciate it.
Thanks for having me.
Ebrahim Poonawala with Bank of America.